One of the best kept secrets amongst finance YouTubers is the word best. Best stock, best index fund, best small cap, best SIP, and of course, best mutual fund. It's a phrase that guarantees a high number of views and watch time, which is probably why every YouTuber uses it in some capacity, including this guy. Now, as important it is to understand what best to do, it is equally important to know which paths are best avoided. And so in this video, I shall take you through 8 different mutual fund categories and strategies, which in my opinion do investors the maximum harm. Mutual funds in India come in 2 variants. There are regular plans and there are direct plans. Think of a direct plan like this apple tree. So there are 12 apples on this tree, and if every apple is a percentage in returns, then the tree is giving us a 12% return. Now in regular plans, there is a broker, agent or banker who is involved, and a commission needs to be paid which can go as high as 1% of the AUM. So effectively, instead of getting 12 apples, you end up with only 11. Now if you think 1% is not that significant a number, take a look at this illustration here. So say on the suggestion of a mutual fund agent, I start a monthly SIP of 10,000 rupees in a regular plan. I am targeting a tenure of 20 years and assuming the fund gives me 11% returns, I would have accumulated a little over 85 lakhs over the next 2 decades. But instead of a regular plan, had I invested in a direct plan, that 1% saving in commission would have given me a higher corpus of 96 lakhs. To put it differently, I would have ended up paying a commission of 12 lakhs to that mutual fund agent for the simple act of getting me invested in an SIP. Now, I'm not saying that an agent has no value to add in my financial journey, but wherever possible, and especially in the case of SIPs, always go for direct plans. A new fund offering or NFO is when a mutual fund company launches a new scheme and raises capital for it from the public for the very first time. Understandably, an NFO is a busy time for marketers and distributors who do roadshows, approach clients, give interviews, etc. to build awareness and warmth for their offering. But from an investor's perspective, one should realize that NFOs are first-time offers, which means there is no track record for the scheme. No performance history, no ranking, no rating, no idea what the expense ratio is going to be, and definitely there is no portfolio that an investor can evaluate and compare. In that context, and especially in categories like large caps, ELSs and flexi caps, which together have easily over 100 schemes, it makes absolutely no sense to invest in the 101st scheme just because an NFO has come up. But having said this, some NFOs can be considered. For example, I see many NFOs coming up which are essentially index, factor-based or strategy-based funds that follow a defined methodology and approach. In such cases, and after a thorough understanding of the material presented, one can consider investing in them at the NFO stage, but to the extent possible, avoid NFOs in the more established categories. A sectoral fund, as the name suggests, invests in businesses within a particular industry or sector. For example, a healthcare fund would include companies that are key stakeholders within that industry, which will include pharmaceutical companies, hospitals, diagnostic centers, medical device manufacturers, and even health insurance companies. And like healthcare, there are sector funds in banking, technology, infrastructure, etc. that allow investors to take exposure in those specific sectors and themes. Now, in my opinion, there are 3 reasons why one should avoid such funds. Number 1, these funds are extremely volatile. And as we can see in this table here, sector funds go through bigger spikes and deeper troughs as compared to the more diversified equity funds. A second reason is the high expense ratio these schemes charge, which in some cases can be over 2% even in case of direct plans. And thirdly, most people invest in these funds based on their historical returns, which is generally a highly unprofitable practice given the cyclicity of these sectors. So unless you have a compelling reason, avoid sectoral or theme-based funds. Credit risk funds have been a poor performing mutual fund category, at least for me. Now, a credit risk fund is required to lend at least 65% of its assets to below AAA rated instruments. This would include securities like debentures and NCDs from DLF Cybercity Developers, Tata Motors, TVS Credit Services, etc. As expected, these borrowing companies offer a higher rate of interest to compensate for the lower credit rating, but that doesn't hide the fact that these funds take on a higher level of risk, which can put the investors' interest and principal in jeopardy. Now, in my view, the risk taken by these credit risk funds does not adequately compensate investors in terms of the returns it offers. In fact, the returns have barely kept up with other categories like the ultra short duration and money market funds, which carry a lot less risk and volatility. And from that perspective, I would avoid credit risk funds and instead would focus on debt funds that offer moderate, predictable gains with a fair degree of capital preservation. I generally follow this practice of not investing, basically avoiding debt mutual funds which have a very low AUM. And that's because when funds don't have enough money behind it, they are very restricted in what they can purchase and how much they can purchase, which severely hampers our diversification requirement that is so important in debt funds. For example, here we have the ITI Dynamic Bond Fund, which presently has an AUM of 22 crores. Now, 22 crores is not a big number, which is probably why the scheme has bought only 2 securities, which is a lot lower than what is held by other schemes in the same category. Logically, a low count makes these funds a bit risky, as a single default can seriously dent the NAV and the scheme performance. And now you know why I tend to avoid debt funds with a low asset base and a low number of securities within it. Okay, so I'm not saying large cap funds are bad. On the contrary, I would advocate every investor to have at least 50% of one's equity portfolio in large caps. But I also think it's the actively managed large cap category that needs a rethink. You see, after the 2018 SEBI reclassification of what constitutes a large cap and what goes inside a large cap fund, a majority of actively managed funds have been struggling to beat the benchmark. In fact, the Nifty 50 index funds have outperformed the average large cap fund in 4 of the last 5 years. And in my opinion, unless something drastic happens, passively managed index funds should be able to beat most of the actively managed ones in most years. The next mistake, which I think is an accidental one, is investing in fund of funds. So an FOF is essentially a basket of funds, and if you're not careful, you might end up with stuff in that basket that you don't want. For example, the ICICI Prudential Asset Allocator Fund of Fund uses not 2, not 3, not 4, but 20 different schemes of its own. And then there are fund houses like Quantum, whose equity FOF fund distributes its assets across 9 different schemes belonging to other AMCs. Now, having 9 schemes or 20 schemes in a fund of fund is a debate in itself. But other than the fact that it completely screws up my allocation, another reason to avoid a fund of fund is the extra charge that one needs to pay.
Remember, I told you there'd be an extra charge.
Of course you told me. What a prick. But let's see what's really happening here. So the Quantum Equity FOF fund has an expense ratio of 0.51% for its direct plan, which is actually over and above the expense ratio of the 9 schemes that constitute the FOF. In fact, I did a rough and dirty calculation on this, and by my reckoning, the total expense ratio, that is Quantum's fee plus the other AMC charges, actually comes to about 1.5%. This double summation is something many investors aren't aware of, but now that you know, do make the combined expense an important area of analysis when considering a fund of fund scheme. So obviously there is no mutual fund category that goes by the name Cool and Clueless. But what I'm referring to here are some schemes which seem to have a larger element of fund marketing rather than fund management in it. For example, there are schemes that come with catchy phrases like India opportunities, business cycles, make in India, ethical fund, etc. Now, as investors, we do have a mild idea of what these funds might be working on, but not everything is clear. For example, Access Mutual Fund has a special situation fund. As an investor, I would presume that there might be 8, maybe 10 special situation opportunities at any point of time, and the fund manager might be focusing on taking advantage of these. But what came as a surprise was that this fund had a much broader agenda, and special situations were not limited to its classical form of acquisitions, spin-offs, asset sales, demergers, etc. What was equally surprising was the number of stocks, and instead of being invested in 10 to 15 stocks as I had originally predicted, this special situation fund was invested in 75 stocks, which I thought was a bit too broad to fit within a special situation definition. My point is, it's important to be careful when working with funds, strategies, or products which are non-standard in construct. Alright, so these were some mistakes, some errors, a bit of learning curve that's happened with me over the years. I sincerely hope you would have learned some lessons from my experiences and will not repeat the same. If you like this video, please share it with your friends and help me grow this channel. Thank you for your time, and I look forward to catching up with you soon on another video. Until then.